All right, let's jump right in. A new piece of research is making a pretty bold claim that the global economy isn't just facing a few bumps in the road, it's actually on the verge of a systemic collapse. So, in this explainer, we're going to break down that exact analysis, look at the warning signs it identifies, and explore the future it's mapping out.
So the research we're digging into today kicks off with a really provocative thought. What if the next big crisis isn't some far-off event we should be watching for? What if it's already happening? You know, a slow burn that's quietly building pressure right under our feet. The analysis suggests that the fragile stability we're seeing right now, well, it's just a mask for some really deep structural problems.
So what's the first big crack in the foundation? According to this analysis, it all starts with a mountain of sovereign debt. The stimulus that kicked off after COVID, well, it never really stopped. It just got baked into the system, leading to these historic levels of government debt that are getting harder and harder to manage.
And to make that debt problem even worse, there's this new wave of political pressure being put on central banks. The paper points out that when politicians start demanding rate cuts to make borrowing cheaper, it really threatens to undermine the very institutions, like the Federal Reserve, that are supposed to be the firefighters in a crisis.
And the third piece of this puzzle, a modern global trade war. The research highlights these escalating tariffs that are essentially creating a permanent supply shock. And this isn't just about who's selling what to whom. It's about embedding inflation right into the global economy, creating this really toxic mix of slower growth and higher prices.
Okay, so with those three drivers in mind, the paper uses this really great medical metaphor. If the economy were a patient, what are its vital signs telling us right now? Let's take a look at the early warning dashboard that these analysts are watching.
This is basically the paper's warning dashboard, and as you can see, a whole lot of red lights are flashing. Let's just touch on a couple of these. A steepening yield curve, for example, is just Wall Street speak for a growing fear that the government can't pay its long-term debts. And weakening Treasury auctions? That just means fewer global investors want to lend money to the U.S. government. But maybe the most telling sign is that central banks are buying up gold like crazy, a classic move when faith in money starts to fade. You put it all together, and it paints a pretty worrying picture.
Now let's zoom in on just one of those vital signs, the U.S. Treasury market. This thing is supposed to be the bedrock of the entire global financial system, but the analysis points to some serious stress here. When you see things like a low bid-to-cover ratio, it just means not enough people are showing up to buy U.S. debt. And when the primary dealer take is high, it means the big banks are basically being forced to buy what nobody else wants. These aren't just abstract numbers, they're cracks forming in the foundation of the whole system. So, we've seen the symptoms on the dashboard, but what's the underlying disease? This is where the research goes deeper to diagnose the structural sickness that's making the global economy so incredibly fragile.
This quote from Jamie Dimon, wow, it says it all. The paper argues that, just like back in 2008, huge risks are building up outside of the regular banking system. This time, it's in the murky, unregulated world of private credit. We're talking about a $1.5 trillion blind spot where nobody really knows how much risk is hiding.
And this illustrates another huge problem that analyst Meredith Whitney points out, the bifurcated economy. See, on the surface, things might look okay because high-end consumers are still spending, a lot of times by borrowing against their home's equity. But underneath all that, lower-income households are just getting hammered by inflation and shaky jobs. It creates this facade of strength that could crumble in a second.
And to really get a sense of the scale of this debt problem, just look at this number from Ray Dalio's framework. It's projecting that the U.S. debt-to-income ratio could hit a mind-boggling 898% within a decade. This is what the research calls a late-stage debt cycle. You can think of it like a business that has to keep taking out new loans just to pay the interest on its old loans. Eventually, the debt itself just collapses the whole company.
The research also really hammers home just how unusual our current trade situation is. I mean, look at this chart. It shows that today's average tariff levels are getting dangerously close to the infamous Smoot-Hawley tariffs from the 1930s, the ones that are widely blamed for making the Great Depression so much worse. It's a massive inflationary U-turn from decades of global trade policy.
So what's the rest of the world doing in response to all this debt and instability? Well, they're hedging their bets. This number represents China's huge gold reserves, and they are not alone. The paper shows a really clear trend of central banks around the world shifting away from the US dollar and into physical gold. It's basically a vote of no confidence in the world's traditional safe haven asset.
Okay, so we've got the diagnosis. The system is sick with debt, political meddling, and trade wars. So, what's the prognosis?
Well, the paper lays out a few different ways this slow-burn crisis could suddenly rupture into a full-blown meltdown.
This timeline lays out one plausible and frankly pretty terrifying scenario. It would start with a shock in the stock market. Then it moves to a liquidity crisis where even U.S. Treasury auctions start to fail. That leads to a policy collision where the Fed tries to step in, but it doesn't work. From there, it triggers global contagion and finally a complete panic or a total restructuring of the system as we know it.
So what's the most likely outcome, according to this analysis? Well, you can see that the odds of a soft landing, where everything just works out fine, are pretty low. Instead, the highest probability is what they call a stagflation trap. For most of us, that's the worst of both worlds. Prices for everything keep going up, but the economy and job growth just stall out. The paper sees this painful, grinding period as the most likely path forward, with a sudden crisis being a very real runner-up.
So, let's pull all these threads together. What's the paper's final conclusion? And what does all this mean for us, for investors, for anyone just trying to navigate this environment?
Here's the most important point. This crisis isn't going to be a repeat of 2008. The research argues it's going to be a dangerous hybrid, combining the worst parts of multiple past crises. We're talking about the trade wars of the 1930s, the liquidity crunch of 1987, the hidden leverage of 1998, and the systemic fragility of 2008, all happening at the same time. And this quote from Ray Dalio just perfectly captures the trap that policymakers are in. If they tighten money to fight inflation, they could cause a massive recession. But if they print a bunch of money to avoid that collapse, they risk triggering hyperinflation. According to this framework, we're probably going to get both. It's just a matter of which one hits us first.
And so we're left with this one last critical question. This analysis lays out all the warning signs with incredible clarity, from Treasury auctions to tariff levels. In past crises, the signs were often there, but they were ignored. The question this research really leaves us with is, are we paying attention this time?